And then on the seller side, the strategics buy 100%, whereas private equity normally buys 70 or 80 or maybe 85%. So there's no rollover equity or second bite of the apple. It's a much cleaner acquisition.
Welcome to the Fueling Deals Podcast, the podcast that teaches how to accelerate your business growth through all types of deals. It's time to fuel up, so buckle in with your host, Corey Kupfer.
There are only two ways to grow your business: organically through sales and marketing and providing great products and services, and inorganically through deals. Too many companies focus only on the first way, organic growth. Welcome to the podcast, which will help accelerate your business growth inorganically. My guests are a huge variety of deal makers and experts on all types of deals who have personal experience that can help you grow, get clear, learn best practices, and avoid mistakes. We discuss everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My guest today is Gary Kane. Gary founded Chimera Strategies in 2011. Chimera provides strategic advisory services on business sales and divestitures and business acquisitions to the lower middle market, employing its proprietary investment banking process, or M&A Light. Gary is a member of the Long Island Business News 40 Individuals Under 40 group, and LIBN considers award winners to be the rising stars in the Long Island business community. Gary's mantra: I would rather be lucky than smart, but I work very hard to be lucky. Gary, it's great to have you on the show.
Thank you, Corey. Appreciate it very much.
So Gary and I have known each other for a few years, and one of the many reasons I wanted to have him on the show is because he focuses in a overlooked area of deals, which is deals, as you heard, for sort of that lower middle market that a lot of investment banking firms don't focus on. So we're going to talk about that. We're going to talk about a few other things around deals. But before we go there, Gary, I want to take you back to when you were a little kid, when you were a little boy growing up. What did you want to be? Because my guess is an investment banker might not have been it back then, but maybe I'm wrong.
Actually, when I was little, I wanted to be a cow. believe it or not, but that clearly did not work out. When I sort of found myself, I wanted to work at a hedge fund. I was really excited about the opportunity to understand and review and look into companies. And that was my dream. And back then, the hedge fund was newer than relatively new and really an exciting part of Wall Street. And luckily, I was able to do that for about 7 or 8 years in the 90s.
Oh, great. So now, what would you consider your first real business, however you define that? Was that Chimera, or did you have something when you were a kid or growing up? I mean, Chimera is really my first business. I had a few fast failures along the way, kind of side gigs or side deals that I was trying to do while working full time. But Chimera is my first real business, and been at it for 8 or 9 years. Learned valuable lessons that you really can't do something on the side or at night. You really got to be either all in or all out. If you want to take the island, burn the boats. Yeah, I love it. So actually, I'm just gonna. You mentioned sort of things when you were younger that dabbled in or whatever. I'm curious as to if you have an example of one of those and maybe a lesson you learned at a young age that has helped you now with Chimera.
Yeah, one of them in particular, and two actually. One of them, I had the beginnings of Ebates, where you would kind of recommend your friend and get paid via the Ebates model. And I didn't have enough money, didn't have enough capital or resources to get that done. The other one, I used to live on the Upper East Side, and I wanted a slice of pizza. And never knew, I was on 76th Street and maybe there was a good place on 75th Street or 73rd Street, and didn't want to constantly walk around the Upper East Side. So I started collecting menus. And my thought was to build sort of a map around restaurants in my area. And shortly thereafter, Yahoo Maps came out and MapQuest, and I was out of business.
I love it.
The learning there is I was right on with the ideas. I just didn't have the capital or the resources, which I know is not an excuse, but didn't have either to really move forward. Again, didn't do it full time, worked full time and tried to do it on the side.
Yeah, it's interesting because I always say that in between idea and manifestation is a that's really where the journey is, right? A lot of us have good ideas, but to actually have them execute. So
that's the key is the execution. Yeah. Ideas are meaningless if you don't execute on them.
Yeah, I got it. So tell us about now that I have the pronunciation right, and I should have known it because we noticed you for a little while. But tell us about what give us a couple of sentences on what Chimera does.
Sure. So I established Chimera in 2010 or 2011, and the thinking was really twofold. One, you have this baby boomer generational trend. The statistics are 65% of businesses are owned or run by a baby boomer. And second, third, fifth generation, not interested, not available, or not capable. So they've got to think about some sort of exit. And second was the hole in the market. And that hole in the market, as you rightly referred to, is what I consider to be the lower middle market. That term is relative for everybody. But the way I define it is above the business broker, or about 0 to 2-3 million in revenue, and below the traditional investment banker at about 25 million in revenue. So we started around 3 million in rev or 500,000 of EBITDA, and go up to about 25 million in rev or about 2.5-3 million of EBITDA. And that's my market. That's called the lower middle market. And we don't approach it as a glorified business broker. We really approach it as a simplified investment banker, because companies in the 5, 7, 9, 12 million revenue businesses really need the advisory of an investment banker, but can't garner their attention given the fee structure.
That's great. So let's talk about some definitions for our audience, right? So what is the difference between a business broker and an investment banker?
Sure. So the business broker is really more like a real estate model. They've got 50 or 75 listings, quote unquote. They list them on a biz buy sell website, which is kind of like an MLS. They put an asking price on a deal, and they basically have a passive marketing campaign. They sit and wait. When they get a bite, they try to close that deal as quickly as they can. And the close rate is probably 20%, something like that. Investment bankers work on, a handful of deals. Close rate is much higher, and they run a controlled auction or competitive process. So they don't work with the first potential buyer that comes in the door. They create a timelined, controlled auction process to generate competition, and it's a much more active marketing, where they basically go out and seek and find the buyer. The other difference is in the business broker space, the buyer is traditionally an independent Joe or Jane, someone that got laid off from Citigroup, or a father who wants to set up their kid in business, or someone who just wants to be their own business owner. And on the investment banking side, the buyer is traditionally private equity or family office. Which is also different than my buyer. As we talked about, my buyer is really the strategic or same or similar company in the same or similar industry.
That's great. So I definitely want to get into the concept of strategic, but before we go there, this business broker versus investment banker, I think that's a great distinction for people who are less familiar with deals to understand. And, also, I guess the other thing that I would add, and you can tell me if you agree, but I think you do, is that, investment bankers also provide a broader scope of services. Usually they are more involved on a strategy and consulting basis to get buyers ready for sale, for example, or to prepare sellers to buy. It's like you said, it's way beyond just sort of a listing, service.
Yes, that's correct. As well as you can go to IPO, capital raising, debt sales, whereas business broker just basically lists properties, quote unquote.
Great. And listen, one of the things that I want to say is that, although obviously the investment bankers provide a more sophisticated role, there is a role at the lower end of the market for business brokers in that investment bankers won't touch it. I mean, even, you do the lower middle market, but there's a below which, it's not worth for you to get involved because you can't provide the level of service you do. So the business brokers do play a role for a certain type of business. But if you have a business that's looking to buy or sell, you really want to determine where on the spectrum you are and which type of person you should be working with. And if you're anything beyond a really small business, then you at least want to consider working with an investment banker over a business broker.
Absolutely, absolutely, and you're absolutely right. The corner deli or the local Main Street clothing store business broker is the absolute right choice for that. And nobody else would work with them. And then obviously, as you get much larger, the business broker doesn't have any training as an investment banker to offer that advisory.
Great. So let's talk for a second about, before we get to the strategic conversation, about this concept of the lower middle market, because, I see it all the time where entrepreneurial businesses who are, successful in that, they have some employees, they're established in that, they're going to be around for a while. They make a very nice living for their owners and maybe for a couple of key executives, but they go to the market to sell, and most of the investment bankers won't look at them because they're in that in between stage. So, and that's your market. So, talk about that a little bit further.
Sure. And it's actually much easier, as you would know, Corey, to do a $500 million deal than it is to do a $5 million deal.
Right.
It's harder. And the reason is a couple of reasons. One, the fees are lower because there's just not a lot of money going around.
Yep.
That's the first step. So they can't get to that $300,000 or $500,000 minimum, as well as that $50,000 engagement fee. Second is private equity won't play in the space because it's too small and it's not worth it for them. So it cuts out a significant buyer pool already. Third, the financials are definitely not audited, sometimes just reviewed or compiled. Fourth, they probably are not growing. There's probably not a second layer of management. They're probably pretty owner-centric, which makes it all challenging. And third, there are no lenders in the space. So, the multiples are compressed because the seller either has to do seller financing or earn out, because there are literally no lenders in the lower middle market space.
Right. So this ties into the conversation of why a lot of your deals, and you gave me a percentage before we went on air. I'll let you say it. Are strategic deals, right? Because if you have so just to make a distinction, listeners up front, there are financial buyers and strategic buyers. If you want to put them into two big blocks, and financial buyers are people who, like private equity firms and others, who invest to get just mainly focused on just getting a return on their money. And they may be looking to buy and flip a company. They may be looking to buy an IPO a company. But the bottom line is they analyze mainly based upon financial return, and they're not necessarily companies in that industry. They're professional buyers very often. And what Gary just said is that, those buyers are not as available, in the lower middle market. So talk to us about the concept of what a strategic buyer is and why the majority of the deals you do are with strategic buyers for your clients.
Sure. The reason why financial buyers don't play in my space is, one is size. They're looking for at least 2 million of EBITDA. And I use the rule of thumb, about 10% of sales is EBITDA. So they're looking for at least 20 million of revenue businesses for it to be financially worth it for them to do all the work involved. Because it's the same amount of work to do a $500 million deal it is to do a $5 million deal, and they won't make as much money at the $5 million. And the second one is just as important. There's no second layer of management usually. Usually it's the owner that's running it, and private equity are not operators. They're financial buyers. And if the owner leaves, who's going to run it?
Right. And in fact, private equity firms, one of the main things they're looking for is a strong management team in place. Right.
That's right. And if that owner leaves in a small business, there isn't a VP. There aren't VPs. There aren't COOs. Generally speaking, there's usually the owner that's really got his hands in everything and a couple of key people. So if that owner leaves, that second layer of management is not existent, and it'll fall apart.
Okay, great. So talk to us about what a strategic buyer is and why those things aren't as much of a concern to a strategic buyer.
Sure. So a strategic buyer, in my opinion, is, and I define it as the following: a company in the same or similar industry, and depending on the business, in the same or similar geography. So I'll give you real world examples. So working on 3 deals in due diligence at the moment. One we have is a venue here in the city. So they rent out space in the city in Brooklyn, and they re-rent. They prop and prep it with furniture, and they re-rent it for events, for photo shoots, and for video commercials. So we're in due diligence. So the buyer has venues as well as their production department. So they rent out his facilities as well as they have their own. So they do the same thing as well as they do something similar. So 86% of my deals are sold to just like that. Another deal in due diligence, we've got a granite and marble stone distributor, a regional distributor. The buyer is a distributor that's about 5 times larger. So they're basically picking up inventory, picking up locations, and picking up people.
Got it. So, so the interesting part is, breaking down what you said before. So those buyers are less concerned that there isn't, a significant management team in place because they have their own management team.
Correct.
And they're usually going to fold in this business. They may take some key employees. Obviously, they want the clients. There may be some intellectual property, but most often it's it's access to the clients, right? Customers that they have, and they have infrastructure. They have back office. They have strategy. People that do it on the various management levels. So they're not concerned about that piece like a financial buyer would be.
That's correct. That's correct. Plus, they've got the potential access to capital, because a bank, if it lends at all, will only lend if someone's in the industry. So they've got potential access to capital. And then on the seller side, the strategics buy 100%, whereas private equity normally buys 70 or 80 or maybe 85%. So there's no rollover equity or second bite of the apple. It's a much cleaner acquisition.
Right. And let's talk about how some of these deals are structured, because you mentioned terms before, like earn out and things like that. And I know every deal is somewhat different, but, even though you're saying they're buying 100% of the company, usually there's some portion up front, some portion over time, some portion that might be an earn out. Talk right. about structure a little bit.
Right. So most of my deals, if not actually basically almost all of them, given that there's really no lenders in that small, lower middle market space, even for strategics, but given that there really isn't any lenders, the terms usually include or definitely include cash, and that's at least 50 to 60% of the purchase price, or else to me, it's not a real buyer. And then the balance is either a seller's note and or an earn out. And I've seen all three. In some cases. Obviously, on the risk scale, you want all cash first, but that's non-existent in smaller deals because they're too owner-centric, so they're too risky. Second would be a seller's note. And then the third would be earn-out. Earn-out is a way we try to goose up the purchase price. And the buyers like it because it says they really believe in their business.
Yeah, so let's break down those last two components a little bit. So for people, we have some very sophisticated listeners, and some people are just getting into the deal space or wanting to learn about it. So when Gary says owner's note, that's basically a promissory note. It's a promise to pay a certain portion of the purchase price on the back end, and a true note. It might be contingent upon not having any breaches of the representation of warranties. In other words, not basically lying about what you promised the buyer. But otherwise, it's an obligation to pay. Whereas an earn-out, talk to us about an earn-out, because an earn-out is different. There's no guarantee you get any money on an earn-out. It's usually based on certain triggers, right?
Right. So it basically, like you just said, the way I like to do an earn-out is based on a percent of sales. So ideally, if the company, and we use it, let's say trailing 12 months or $1 million in revenue, and you want to pay 10% of sales. So ideally, they would get 100% of that purchase price. If the business stays exactly the same for the 3 years, the earn-out is in place. If the business grows over that period of time, they should get paid more. Just as if the business shrinks over that period of time, they would get paid less. What doesn't change is the percentage of usually sales, but it could be sales, could be gross profit, could be other things. But usually that percentage stays the same. What fluctuates is the base. So the base being trailing 12 months of sales, that's when we lock it in, and you would get paid a percentage. And the idea where you have a win-win with the buyer is you and the buyer help grow it, which means you make more money over time.
Right. So, and it's a pretty common element. It's not in every deal, but it's a pretty common element of a deal, and it's used to for a number of purposes. I mean, one, to protect or incentivize, right? People going forward. Also, I've seen it, Gary. I'm sure you've seen this as well, where it's sort of the way you close a difference in purchase price desire, where the seller wants a higher number, the buyer wants a lower number, and part of the reason why the seller wants a higher number is he thinks things are on an uptick and doesn't want to leave some of that upside on the table, and the buyer says, "Well, yeah, but what if that's just what you think is going to happen? How do I know it's going to happen?" Right?
Right. You're exactly right, and I can give you an example there too. Experience share on that. So I was doing a deal a couple of years ago in the food and beverage industry, more specifically Italian sausage. Phenomenal guy, perfect fit. He does 4.5 million in revenue, third generation, 60 years old. The buyer was another food company about 2 times the size. And during due diligence, chicken prices tripled and EBITDA came way down. And the buyer is screaming, well, I priced the deal on EBITDA. Now EBITDA is significantly lower. And the seller is saying, well, chicken prices go up and down. I didn't raise prices because I know it's going to go down. I've been doing this for 40, 30, 40, whatever years. Chicken prices go up and down. It's just a blip. So we decided on changing the structure a little bit into an earnout, betting on the fact that chicken prices will come down and EBITDA will go up. And the last time I spoke to him a month or 2 ago, that exactly happened, and he's on track to get his full amount.
Right. So that's a great example. And by the way, most of our listeners know what EBITDA is, but just for the few that may not, it's earnings before income, taxes, depreciation, and amortization. Basically, in a layman's way, you basically look at net profit and cash flow, after adjustment for non-cash items like depreciation and amortization.
Corey, if I may, you said earnings before income. It's earnings before interest.
I'm sorry, interest. Thank you.
Yeah.
Earnings before I misspoke. Earnings before interest, taxes, depreciation, and amortization. So it's fundamentally your net cash flow adjusted by the non-cash items. And that's a pretty common way. Just to speak to valuation for a second, right? Sometimes in some industries you'll hear about revenue multiples, but companies have different profitability. So EBITDA is a much more common way that any kind of sophisticated buyer is going to analyze a deal versus gross revenue.
That's correct, and especially in the smaller deals, obviously the SaaS deals, the technology deals, they're potentially priced on revenue. But in my world, if you're under $1 million of EBITDA, you're probably at a 2 to 3 times multiple. If you're $1 million to $2 million of EBITDA, adjusted EBITDA, which means your EBITDA plus or minus the adjustments, maybe owner's compensation, maybe rent if they own the building, 1 to 2 million EBITDA, you're probably at a 3 to 4 times. For 2 million to 5 million EBITDA, you're probably at a 4 to 6, 4 to 7. 5 million EBITDA, you're 7 plus. And the reason there is you've got lenders.
Right. Once you get into the larger deal, right, there's more ability to finance.
Yeah. People will lend. That's correct.
Yeah. Talk a little bit about what you're seeing, if anything, in terms of trends in this lower middle market, in terms of where the economy is, just trends overall, any concerns that you have moving forward?
Yeah, sure. So it is absolutely a seller's market, which I'm sure you've heard. There's a tremendous amount of capital in private equity hands and family office hands, even in company hands. And people want to put that money to work. So multiples are definitely higher than they've been. I think the following: everybody's waiting for this baby boomer generational trend to start selling, and some of them have. And I'm not sure if the wave has come as much as we have all thought. And my reason is the following: is that for the last few years, business has been good, economy's growing, sales are growing, making money, having some fun, doing as opposed to 08, 09, 10, having fun, right? Making money, things are a little bit easier. Why sell? And the challenge there is when things turn, they're going to say, man, this is hard. And when they turn, nobody knows, but we know it will all turn. Man, this is hard. I'm not making as much money. I want to sell. But their expectations are still in line with what they are now versus what they will be in a not as good of economy.
It's fascinating to me because I had this exact conversation on episode 1 of Fueling Deals. So listeners, if you haven't listened to that one, you can go back. I had Dave DeVoe on, who's an investment banker who focuses specifically in the investment advisory space. And, the demographics in that space particularly are, the average owner is approaching 60, in that space. And he feels like there are half the deals going on that there should be in that space. And it sounds like you feel in the broader market, it's somewhat similar. And we also had a conversation about, it's interesting. On the one hand, you don't want to try to time the market because I don't believe anybody can. But on the other hand, I've seen too many businesses do exactly what you talked about, which is that they say, hey, why should I sell now? Things are good. The money's cruising in. But then the next downturn comes and they're 64 years old or 68 years old or whatever the number is. And it's going to be 5 years before things come back up anywhere near what they were. And then, they sell out, when it's heading towards the bottom.
That's right.
Yeah.
That's right. It's you got to buy on the rumor and sell on the news, sort of. The other thing they don't realize is how long it takes to do a transaction and how long they're involved. So, when you start with an engagement agreement, the average transaction can take 9 months to do the transaction, and then depending on the buyer, you've got an employment agreement for at least 3 or 6 months, and as much as 5, with the average being 3. So all in, it'll take you 3 or 4 years to be out anyway. So if you're 62, 63, they're not thinking 67, they'll be done. And that's what I stress. But it doesn't happen overnight. There's a tremendous amount of activity and difficulty in closing a deal. The fastest I've ever done a deal is 7 months. The slowest I've ever done a deal, I'm actually still working on it since 2016. We've been trying to close every day now for the last month, but literally 3 years of work.
Yeah, and listen, so where I come out, and Gary can say whether he agrees or disagrees. Listen, if you're thinking you want to sell your business in 8 to 10 years, there's some things, by the way, you should start doing now to get prepared for that. But it's not like you're necessarily going to rush, and just because the market's high, you're going to get out. But on the flip side, if you're thinking, hey, you want to get out in 2 or 3 years, you may want to consider the where the market is now, and that there's no guarantee it's going to be there 2-3 years from now, and at least consider accelerating your process.
Right. I would add to that in the fact that, if you take the emotion out of it, if you can get a premium for an asset now, you sell it. And I think you can get a premium for their assets today, irrespective if they want to sell 3, 5, 7, 9 years from now. But it's that emotional component that comes into play as well.
That's right. I mean, I've had clients say to me, I forget whether I might have relayed this on a prior episode, but I had a client many, many years ago. I'm going back 20-something years, and it just sticks with me because he was in his 30s and he really hit it well. He had a firm where he placed tech people in Wall Street firms, at all the big investment banks, and he was killing it. I mean, the business blew up. He was doing $20-30 million in revenue as a 30-something-year-old guy, and and I was saying to him, you should consider selling this thing. The multiples are ridiculously high right now. Plus, I also knew that Wall Street had this thing where they would outsource all of their IT stuff, and then the new person would come in and they would say, why are we paying all these, consultants? We're going to bring it all in-house. And then it would be, so he had 2 major risks. One was general economic, and market risk, economy, et cetera, the market. And then he had this risk that just the cyclical nature of the outsourcing versus not on Wall Street. And, and he didn't sell. And his reasoning was, well, what am I going to do, Corey? I said, you're a smart guy. You'll start another business, whatever. Right. You can travel the world. If you don't want to travel the world, you'll start another business. But he didn't sell. And multiples dropped to literally 1/10 of what they would have been at its height.
And probably his business fell off too.
Yes.
Again, it's the emotional component also. And they don't think of it as an asset to buy and sell. But the other piece of that is, is you take out your 3-year non-compete, you're done. You could do whatever you want. You could start another business just the same.
Right. That's right. And listen, I get it. There are other people, other reasons that people are in business sometimes, and it's just not about the money for them. And I'm not saying that they should always make the decision there, but I think they should consider some of the factors that you and I have talked about.
Exactly.
Okay. So, there's so much we can talk about, but we are, coming to the end here. And let me, I'm going to have a last question for you. But before we do, I'm sure people have gotten huge value from listening to you today. And if they're, in that lower middle market space and thinking about buying or selling, or just want to find out more information about you and what you do, what's the place for them to reach you or check out more information about you?
Sure. So I've got a website, www.chimerastrategies.com. That's C, H as in Harry, I, M as in Mary, ERA strategies.com. I'm on LinkedIn, of course, as well as the number is very easy to remember, 1-855-CHIMERA. So that's 1-855-244-6372. So as accessible as I can be.
That's great, Gary, and I definitely appreciate all the value you provided. My last question that I always ask people is: anybody who knows me, and I think you know me well enough, that and know that authenticity is one of my highest values. There's a reason why my book is called Authentic Negotiating. And for me, authenticity is not about external morals or even integrity, which is a different conversation, but it's about aligning your business decisions, the deals you do, your life choices with your inner truth, with really what is it that's true for you and not being influenced by maybe some other external factors. I'm curious as to how you stay authentic and whether when you advise your clients, so I'll ask it twofold, whether that conversation comes into a play at all when you deal with buyers and sellers.
Yeah, very good question. I appreciate that. The first one I can definitely answer, and unfortunately I learned it the hard way, as most people learn things. But since 2017, I've worked on 9 deals. I've closed 7, and I've got 3 in due diligence at the moment. So I've got a 78% close rate, which I would suggest to you is very, very good and probably comparable to investment banks much, much larger than me doing much larger deals. And what I learned along the way and what I abide by now is 3 things in a potential client. One is a good business that I truly think I can close at least 75% of the time. 2, and is really key, a good person. It's got to be a person I truly want to help. I learned the hard way that if I'm thinking with my wallet and not my head, it doesn't work and you don't close a deal anyway. So that's how I really stay true, is I really try to work with interesting businesses, people I really want to help, and people who are realistic in their expectations of price and terms. And that's where I came to in 17, and that's how I got to where I am today and how I stay authentic. The second part of your question is you can always walk away. So if something doesn't feel right, if something doesn't sit right, if things are just not going well, you're entering into a marriage. As much as everybody wants to close a deal, and when the train has left the station, it's very challenging to shut it all down, no matter how much money you spent on lawyers, accountants. I advise my client that you could always walk away. If something isn't sitting right, you could always walk away. However, if you do, what's your BATNA? Do you have another alternative? Is there something else out there? Or are you just walking away for whatever reasons? But you always have that option. And that's also what I think it makes it authentic is I'm always saying to my client, because the negotiations get very difficult, things get very trying, there's lots of back and forth. You can always walk away, but do we want to?
Right. From an authentic place as opposed to from some upset or anger or temporary, frustration, right?
That's right. That's right. Because these negotiations get very difficult, as you know. People get very emotional, and it's my job to really be the calming voice. And yes, we can walk away. Yes, we can take our money and run. Yes, we can make more money next year, the year after. But is that the right thing to do when cool heads rule?
That's great. Gary, thank you so much for being on the show today.
I appreciate it. Thank you. Thank you very much, Corey. I really enjoyed it.
And thank you, Fueling Deals listeners, for tuning in. Remember, there's only one difference between companies that grow inorganically and those that don't. And it's unrelated to size, amount of capital, or any other factor, other than that the owners and executives of companies that do deals make a decision to do deals, and then they take action. It's time to refuel. So until next week, Corey Kupfer signing out.
Thank you again for tuning in. Be sure to leave Fueling Deals a rating and review on iTunes and Google. Check out all our episodes at fuelingdeals.com to find out more resources to accelerate your business growth.